We are here today to talk about leveraging your bookkeeper to get more money out of your business. My name is Peter Denholm. I'm the managing director at Supporting Strategies Northeast Florida. A little bit about me before we get started. I got 20 years of business management experience, a lot of that comes from KPMG, PricewaterhouseCoopers, working with Grant Thornton and some Fortune 50 companies. During that period, I really specialized in helping organizations improve their financial and operational processes. Currently, I have been working now for the past 4 years at Supporting Strategies Northeast Florida. I have a finance degree from George Washington University. I am married with a 10-year-old daughter, and we live in Jacksonville, Florida. Now, let's get started. Excuse me. Today's objectives. What we want to do is understand really what is the foundation for good bookkeeping processes. Next, know what financial reports are central to running your business. So we'll talk about those that are really critical. There are a lot of reports you could use, but we're going to talk about really 3 critical ones. And know what questions to ask when you're reviewing these reports, where to find the answers in the reports. So keeping all this in mind, the reason you do bookkeeping is more than just for record keeping for your taxes. It's really to grow the value of your business. And here we are, growing the value. So the result of good bookkeeping processes, it really starts with a foundation. In order to get there, you've got to have the right systems and processes in place. And we're going to talk about that. Your books, ultimately, these need to come together so that they are accurate, they're GAAP compliant, and they're timely. Excuse me. Businesses really are made or broken by the decisions they make. So if your books are not accurate, if they're not GAAP compliant or timely, then you're really handicapped. GAAP, coming back to that, that's a generally accepted accounting principles. GAAP is a common set of accounting principles and covers things like revenue recognition and balance sheet classification. We're going to touch a little bit more on GAAP later. Bottom line, if your books are not timely, then you're excuse me. If your books are not timely, meaning you're not producing them on a monthly basis, really before the next month ends, then you might as well be reading your company's obituary. So let's avoid the obituary. Let's get started. The foundation is really the structure of the accounts. How are you recording the transactions within the books, and at what level are you recording them? So there is a chart of accounts. Think of the chart of accounts really as the all the expense lines and the different revenue streams that you may have coming in. That needs to be organized, but also think of it as a Rubik's Cube. There are other things that you need to make sure are organized. You've got classes that can divide you into divisions. You can use the classes in many ways to break down your business into different the revenue streams. What's my profitability for e-commerce? What's my profitability for wholesale? What's my profitability for retail? Those types of things. The customers, vendors, your products and services, they all need to be categorized. So for instance, I recently brought on a client in our business that had over 200 lines on their profit and loss statement. For a $1 million company, that's not manageable, and it was a mix if the expense lines were vendors. So setting it up is setting yourself up to win. And what needs to be recorded, what needs to be done once you've once you have that foundation. First and foremost, I see this a lot with small business owners. Personal expenses must be separate from your business. This is considering commingling funds. The IRS doesn't like that. Also, if you know, and I realize why you're doing it. You're a lot of business owners are doing this to show a low net profit to avoid taxes. You know, effectively, that's really lowering the value of your business, and we're here to talk about it to increase the value of your business. So, recording your personal expenses in to lower your net profit, really, what you're doing is you're saving 38 cents versus earning $2.50 when you go to sell the company. If you're an LLC, your corporate veil is considered pierced by commingling the funds. So in short, a customer can take your house. That's another reason. Also, you're just simply not protected by the LLC. Finally, from a bookkeeping perspective, it's very time consuming to go in and identify personal expenses versus corporate expenses. So for all these reasons, let's keep that out. Let's move on. Reconcile. You need to reconcile every balance sheet account every month. End of story. It needs to be done. And it should be done before the following month closes. So it needs to be done really within the first 15 days so that you can close the books. Close for our purposes today means you're locking the books. And then locking the books so that you're not changing anything in the past. There's nothing worse than printing a report a month or two later, giving it to your investors, reviewing it for management purposes, giving it to your bank, and your numbers have changed. So the books need to be locked. That can be done in any accounting system. Good management, you should have a budget. Budget can be uploaded to any of these QuickBooks, any of these systems that small businesses are using, as long as you're using one and you're not using Excel. And you should be on the accrual method, not the cash method. There's a more complicated answer to this, but simply put, GAAP compliant versus not GAAP compliant is what this means, and we'll talk a little bit more about this on the next page. So the accrual method. Choosing accrual over cash accounting will give you more accurate way to predict your trends, and we're going to talk about tracking your trends a little bit later, and even the ability to diagnose potential issues in your earning capabilities. Very difficult to do when you're on a cash basis. And simply put, cash is the method that requires cash to change hands, meaning that transactions are recorded only when payment is received or made. Effectively, there's no real accounts payable and no real accounts receivable. You can't see what's supposed to be coming in, and you can't see what's supposed to be going out. Very difficult for planning purposes. And quite frankly, banks will be difficult to consider you for a line of credit or a loan if your revenue is over 500,000. Investors won't consider you. There's just and difficult to plan. So let's make sure that you're on an accrual method so that everything else going forward really makes more sense from tracking your trends and taking care of things. Before we get there, let's talk about the systems. We talked a little bit about the processes. Let's talk about the systems. You need to leverage technology. In today's day and age, it is going to putting your stuff in the cloud and connecting the system so that the data flows is going to take the burden of a lot of data entry. It's secure. Backup is always there. Anyone can access from anywhere as long as they've got the right credentials, of course, or access to the internet. Now, I recognize that there are some legacy systems out there that you need to integrate with that don't necessarily work with, say, QuickBooks Online or something like that. Then, that's okay. It'll get there soon. let's talk about some of the things that you might be able to use, even if you're using the desktop version. Some of these things may work. So payroll. Always use a payroll provider. It's going to be faster, more efficient. This doesn't really have anything to do with the cloud, but they're going to make sure the payroll taxes are taken care of and stuff. It is not efficient for your bookkeeper to be calculating your payroll and paying your payroll taxes. Outsource that to a payroll provider. That's just that's what we recommend to all our clients. We don't do that in our business. It's not efficient. Payroll providers are much better at that, and they can help you automate your timekeeping. Accounts payable and accounts receivable. There are some tools out there that are worth looking at to automate things. Bill.com. To automate bill paying, and Tally to automate the expense reimbursement process, and receivables. Wouldn't it be nice to send an invoice and have a client be able to click on a button and pay either through ACH, their bank, or through a credit card? So looking at these systems, all your technology should feed into your accounting system. Therefore, your bookkeeper really just needs to monitor and make sure things are categorized. But for the most part, there's really less work to do and becomes more paperless. A couple more things to think about when leveraging technology, really on the operational side. If you're a product company, inventory management is very critical, and there are a lot of tools out there that can help you from the vendor side, the customer side, and also managing fully integrated, better than what's out there with QuickBooks Desktop, if you will. E-commerce, you can connect Shopify to these tools. Amazon can all be connected. Recognizing there's industry-specific operational systems. If you're a lawyer, you're looking for a new system, there's one out there, Clio, if you will, for case management. That integrates really well, flows the information in, the receivables, the invoicing that you're doing with the clients, that flows right in. Less work to do from an accounting processing standpoint. And then finally, reporting. There are some tools out there worth looking at. Not going to go into detail today, but Fathom and Futrilli are both. Fathom would be the low-end one, really for tracking metrics. Futrilli is a really good tool for creating a budget. Bottom line, technology is going to help you reduce your data errors, speed up recording transactions. It's secure. It's accessible anywhere you have access to the internet, and it's always backed up. Let's move on to the reports. The top reports that we really need to look at: cash flow, profit and loss statement, balance sheet, and these are listed in order of importance. Let's cover these. So the cash flow statement tells you where your cash comes from and where it goes for the key parts of running a successful business, right? As you can see here, it's organized into operations, investing, and financing. And at the end of the day, resulting in a net increase, at least we hope, a net increase in cash. Just want you to understand the structure of these three. We'll go into a little bit more detail about reading them. So there's your cash flow statement. Profit and loss statement is organized at the top with your revenue, your sales, and then there's two levels of expenses, if you will, that I want to make sure you're covering. Your cost of goods sold. These are expenses that are directly related to the production or delivery of your good or service. So for instance, if you're selling a product, you have to buy raw materials from somewhere to put together the product and to sell it. Those raw materials are considered the direct cost. They go up there. Below the line, below what you see as your gross profit, into the operating expenses are really the advertising, administrative, your rent, lease, those types of things. They don't They don't have to do with directly delivering your product. And then below that are your non-operating activities, interest expense, in this case, loss from a lawsuit you can see on there. At the core here to think about is you've got the gross profit line, the operating income line, you can see that in the middle, and then the net income at the bottom. And we'll cover those a little bit later. Balance sheet, real quick. The left side is assets, and the right side are your debts and your capital, the equity, owner's equity. And the assets need to equal the liabilities plus the capital, right? Again, not going to go into great detail, but we'll come back to these to understand what we need to look at. So, what do we need to do? How are we going to increase the value of our business? So, follow the key trends. Know your numbers. Key trends. So, for instance, on these reports, they should be printed off for you. It's February. You noticed in the income statement probably, and we'll come back to that, that the income statement showed by month. It had January and February in it. I'm sorry. Let's assume that we're in March. So you want that report to show January and February. This way you can start looking by month. You can see the trending that's going on. More importantly, at the end of the day, as you're looking at these reports, are things increasing, decreasing? Ask yourself why. We need to look deeper. Let's talk a little bit about that. So on the cash flow statement, the reason this is most important is you can run out of cash even when your business is very profitable. A profit and loss statement says nothing about, for instance, the principal payments that you make to your bank. They just don't show up there. This is where they show up. So you have you could have reasonably good profits showing on your profit and loss statement, but the amount of money you pay your bank every month could be putting you out of business. So your review should focus on creating excess cash. For instance, a few lines here, if you're a product company, is that inventory if you're using the inventory more efficiently, you could be creating cash. We'll talk about that. If you can collect your receivables faster, you'll be creating cash. There's a couple metrics here, inventory turnover and accounts receivable days, that we'll look at that you can monitor, and we'll look at those later. Those will help create cash if you're managing those, monitoring those. Another thing to think about is if you can pay less for capital equipment that you need, you're creating cash while spending money. A little bit more in review for the cash statement. Look at it as, why is there less cash? Did you buy more capital? Did your inventory increase? Did you extend more credit to your customers? Therefore, your receivables are going up, cash down. Can I afford to increase debt? If you can, do you need more capital equipment? Can you increase your overall capacity? Can you increase your inventory? Can you add more customers? So your cash flow statement can help you as you start to ask why. Cash flow statement can tell you yes or no, potentially. Can we do these things? Profit and loss statement. A couple things on here. I mentioned before that you could see January and February on here. Now I've added another column that wasn't presented earlier. It's a percent column. These are metrics, probably the most critical metrics for you on the profit and loss statement. What is your gross profit margin? What is your operating margin? And what is your net income margin? And you can see in this particular case that although the company sold more, had more revenue in February, they were actually more profitable at every level on the gross profit margin at 28% versus 25%, the operating income in the middle there at 13% versus 12%, and net income at 14% versus 11%. These margins are very important. Your sales may be going up and down, but how efficient are you with your expenses? Write these down. These need to be monitored. Your balance sheet. We said before, you got assets on the left, liabilities, owner's equity or capital on the right. What you're looking for really are operational issues on here. Is your accounts receivable that you can see on the asset side here at $2,000, is that increasing? Are there invoicing issues? On the accounts payable side, especially if you're monitoring month to month and didn't show a comparison here, space constraints. But if you're monitoring this month to month, you can see January, February. Let's assume now we're in June. You can see January, February, March, April, June. What are your accounts payable doing? Are they trending up, trending down? So these are two key things to continue to monitor and begin to always ask questions why. Why is it going up? Why is it going down? What are we doing different? What policies can we change? Two ratios that you can pull from the balance sheet to add to your list of ratios. We talked about those margins, the gross profit margin, the operating margin, the net income margin from the income statement. These are two margins here, the current ratio and the debt ratio, that you should be monitoring from your balance sheet. The current ratio describes the ability of your business to pay its bills, while the debt ratio describes the ability of a business to pay its debt. The debt meaning, are you leveraged from financing your equipment? And on the bills side, this is dealing with, you notice in the formula, it's a current ratio. The current assets, the current liabilities. These are things that are less than a year due, as opposed to the debt side, which are things that are more than a year. You can read the details in there. Conversely, if you will, the higher the better in the current ratio, and on the debt ratio, lower is better. And as a rule of thumb, on the current ratio, less than a 1 means you got cash issues. The debt ratio, 0.5, is reasonable for most industries. If we talked about these metrics, again, the margins from the income statement, these ratios. When we mention point on the debt ratio that 0.5 is reasonable for most industries, what's critical really is that you work with your bookkeeper, your controller, to understand what are the standards for your industry. So not only you're measuring yourself from a trending perspective, but you're measuring yourself from an industry perspective. How am I doing against my industry peers? We're beginning to run a little short on time, so let me just highlight these next two metrics. I mentioned we were going to come back to the inventory turnover and to the accounts receivables days. These two metrics create cash. They were identified, the inventory and accounts receivable, as things you need to pay attention to on your cash flow statement. But interestingly enough, in order to really understand the cash creation, you've got to pull the numbers for the inventory turnover from the income statement, meaning the cost of goods sold circled there, and the inventory from the balance sheet. On the next one here, accounts receivables days. This is one where, again, in order to make this calculation, and you can see what's written there, in order to make the calculation, you need to pull the accounts receivables number. That's going to be on the balance sheet, and use the revenue, annual revenue for the period. And this example is showing you a period of your receivables days calculated for a year's period. So effectively in monitoring this, if the average days is very close to the payment terms that you grant your customers, that may indicate that your company's credit policy might be too tight. Something to think about, something to monitor, something to question. Do I need to change policy? So let's put it all together. From a decision standpoint, you've got these reports. Monitor your trends. By month this year, even this month this year, and versus the same month last year. So how did you do in March of this year versus March of last year? Are you seasonal? So you may want to do that. Very important. On the profit and loss statement, we talked about uploading a budget. How are you doing against your budget? And the key metrics, this list right here are the ones we covered. Your gross profit margin, your operating margin, your net operating margin, current ratio, debt ratio, those two are from the balance sheet, accounts receivables days, inventory turnover, those come from both the income statement and the balance sheet to calculate. And then identify your industry key metrics. If you're monitoring these metrics, you're looking at the trends, keep asking yourself why. So this was a quick 27 minutes, 28 minutes, but let's review this. Wanted to make sure that you understand the foundation for good bookkeeping processes, right? Reconcile all the accounts on the balance sheet every month. Use technology to speed things up and reduce errors. Lock the books. Produce reports monthly. Next objective, know what reports are central to running your business, right? The cash flow statement, most important, profit and loss statement, excuse me, and balance sheet. Know what questions to ask and how to answer them. Mostly, keep asking why. Monitor those metrics, monitor those trends. Keep asking why. Well, that brings us to the end. Thank you very much for your time. Remember, these things are how you're going to leverage your bookkeeper to increase the value of your business. Have a good day.